Hey folks, my name is Jeff Ajitsi. I'm a Senior Investment Advisor at KPF Global Investment Strategies, and I'm with you here from Kensington, New Hampshire. I wanted to talk to you today about market volatility. Scintillating concept, but hopefully we can make it interesting. So, one of the things we've observed at KPF Global is that market volatility, measured as the fluctuation in market prices, has been exceptionally low. Especially over the past couple of years. And it's a bit inconsistent with what we know about the world right now. So we want to talk about that divergence, the causes of it, and what it means going forward. And to do that, we'll first sort of dive into a primer on what volatility is, how it's calculated, and what it means, what it tells you about investor behavior. So, very literally, market volatility, let's take equity market volatility in this example, is the degree of fluctuation that you see in asset prices. So, simply how much a stock price or a market price fluctuates on a day-to-day basis. The wider that range, the more risky the market or the stock is perceived to be, i.e., Netflix is a much more volatile stock than Procter & Gamble because Netflix is perceived to be a riskier company. It's more uncertain. There's more uncertainty with respect to the ultimate fate of the company with Netflix than with a very stable company like Procter & Gamble. And so when we say that market volatility, the volatility of the broad equity market, is extremely low right now, you can argue that that means investors believe that there is very little uncertainty with respect to the market. They're not worried about a wide range of outcomes. They feel like they pretty much know how the global economy is going to unfold, and it's going to be a benign scenario for the equity market. Now, does that square with what we know about the world? Well, over the past couple of years, we've seen the old guard get toppled. We've seen Donald Trump get elected in the United States. We've seen the United Kingdom leave the European Union. We've seen populist candidates gain tremendous momentum in Europe. And so the toppling of the old guard is something that is not consistent with high levels of certainty and low levels of volatility on the markets and the global economy. We've seen an acceleration in climate forces. We saw a record flood in Houston, Texas due to Hurricane Harvey, and in the same hurricane season we saw a hurricane that produced some of the highest winds ever to be recorded in the Atlantic. And so that's not consistent with a world that isn't changing and that's very stable, and with a world that has low levels of market volatility. And finally, we've really solved nothing financially since the financial crisis. The debt, the leverage that existed in the system and that contributed to that financial bust still exists. It's just been transferred from the US financial system and from the US consumer to governments and from developed markets to emerging markets. And so the leverage is still there. In many cases it's higher, and we still haven't dealt with unfunded liabilities such as pensions, Social Security, Medicare, Medicaid. Those things are tens of trillions and even hundreds of trillions of dollars that we're not expected to be able to make good on as a country. And so the level of outstanding debt is something that is not consistent with a stable financial system, high certainty around a benign global economy, and therefore low market volatility. So in our view, there is clearly a wide gap between market perception and our underlying reality. And part of that is because we're in a good part of the economic cycle. The economy's been growing for some time. We haven't had any calamities, and so people are reluctant to price in uncertainty. They're sort of anchored to the recent past. And what has got us here, what has gotten us into this sort of Goldilocks scenario, is one of the most interesting aspects of all of this. And so if you think back to the late 90s, when long-term capital management, a highly leveraged hedge fund, nearly went bust and nearly took the financial system down with it. the Federal Reserve organized a cohort of banks and dropped interest rates significantly in order to engineer a bailout of the fund and the financial system, and curtailed a potential significant market crisis. That event coined the term known as the Greenspan put. And what this means is essentially the expectation that central banks will come to the rescue when there's a significant market crisis and make sure the worst case scenario doesn't materialize. We saw that happen again in the US financial crisis in 2008, when Lehman Brothers was temporarily allowed to fail, and once we had to deal with the actual repercussions of that, the government and the central banks came to the rescue with quantitative easing, with TARP, and with a variety of programs that essentially allowed, effectively bailed out the banks and effectively prevented a worst case scenario for the markets and the economy. So the underlying theme here is the official sector being unwilling to allow capital markets to go through their natural processes and clear the deck when bad debts build in the system. And we've seen this in other places too. European sovereign debt crisis, the mechanisms were created to essentially buy bad government debt using taxpayer dollars in order to suppress interest rates and prevent a sovereign debt crisis in Europe. In China, whenever there's a major growth slowdown, the government will pull infrastructure projects forward in order to boost growth and avoid a negative scenario with the economy. So this is becoming pervasive, this idea of the central bank put, which insulates investors from experiencing a worst case scenario for the markets and for the global economy. And we're not going to get into arguing morally whether it's right to intervene in the markets or to let busts happen unchecked. But we do think there is tremendous moral hazard that is created by this central bank behavior and that it influences markets. And so if you are an investor who is determining their view on a company or on a market and determining how much they want to protect their portfolios, well, if they think the central bank put is there, if they think the central bank will curtail any market declines, they're going to be incentivized to take more risk. They're going to view a narrower range of possible outcomes, and they're going to drive the price for market insurance lower because they're not going to place a high premium on the ability to protect their portfolios. They're not going to pay up for market insurance. And the VIX, the fear gauge, which measures implied volatility in the markets, is essentially a measure of how much it costs to protect your portfolio via options. So the fact that the VIX, implied volatility, is extremely low right now means people don't want to pay a lot of money for insurance on their portfolios because they don't believe that central banks will allow anything bad to happen. That's one manifestation of what's going on, and it essentially means investors are extremely complacent with respect to the potential risks in the global economy because central banks have created this perception that nothing terrible will be allowed to happen. We won't have any more major recessions. Janet Yellen basically said we wouldn't see another financial crisis in her lifetime. And the perception around risk has been completely changed. Not only that, but there are other factors at work that are sort of lubricating this progressive fall in volatility. One is that investors are just directly betting on lower levels of implied volatility. Given the backdrop of central banks backstopping the entire market, people are being incentivized to bet that volatility will keep falling. And so this chart we show you shows speculative activity in VIX futures, implied volatility futures, and the fact that the chart shows a large net short position shows you that investors are very confident in betting on volatility to fall lower still. Another way investors are expressing this belief is by engaging in option writing strategies. Strategies that are selling or writing options, taking an income, and at the same time betting that implied volatility will fall further still. It's another manifestation of the same behavior. And lastly, and perhaps the most interesting, is the increasing prevalence of quantitative funds means that volatility is being driven lower still by the portfolio construction strategies of these funds. Now let me explain. Most quantitative funds, whether it's risk parity funds, managed futures funds, global macro funds, equity market neutral funds, have a strategy of targeting portfolio volatility. Essentially, they want to keep the volatility of their portfolio within a specific range. In order to forecast the volatility of their portfolio, they observe the recent volatility in the market and say, well, that's the best estimate for what volatility is going to be going forward. So I'm going to structure my portfolio accordingly. Well, if the assets that they're buying are showing progressively lower levels of volatility, they're going to say, oh, these assets that I own are less volatile now than they were in the past. In order to keep my portfolio at an appropriate target at the appropriate level of volatility, I need to buy more of those in order to hit that same volatility. Because I'm not getting the same volatility bang for my buck as I was before, because asset volatility is falling. So I have to buy more. So the idea is that as volatility falls, it creates buying pressure from these quantitative funds that have to buy more assets to increase their portfolio volatility. Well, what does that do? So we've observed historically that asset volatility and asset prices have an inverse relationship. As stock markets rise, stock volatility tends to fall. So if you have buying pressure coming in from quantitative funds, pushing up markets and driving volatility lower, those same quantitative funds that are doing that are going to have those now lower levels of volatility in being used to forecast their future portfolio volatility. Another way to say it is that it's a self-reinforcing loop. The quantitative fund sees asset volatility is lower, it says, hey, I have to buy more assets to hit my target volatility. Then buying more assets pushes volatility even lower. So they have to buy more to hit their target volatility. It's a self-reinforcing cycle that drives volatility progressively lower, assuming that these quantitative hedge funds, their trading activity, have an impact on the markets, which they do, because trading volumes are so low now, and quantitative funds are becoming a higher and higher fraction of that daily trading volume, meaning they do have an impact on the activity in the markets. Part of that is due to the explosion in passive investing, which you all know about, and which is another major feature of this decline in volatility, in part because passive investing requires much less trading activity on the part of investors. So if there isn't cause for the markets to move, if there aren't people buying and selling on a daily basis, they won't. So that's true. There are very few humans trading the market as has been the case in the past. Now people are buying index funds, there's less money floating around there in active management, and most of the day-to-day trading is algorithmic or quantitative. And a lot of it is based on these sort of volatility targeting frameworks that I've discussed. So that really does give weight to these sort of self-fulfilling, self-reinforcing processes that keep driving volatility lower and markets higher, sort of without any regard for fundamentals or for catalysts that take place that maybe at one time would have been meaningful, i.e. the market's ability to completely ignore all of this saber rattling around North Korea. Even though it is a very dangerous situation, the market refuses to acknowledge it because it's not really people trading the markets. These sorts of self-fulfilling feedback loops, by the way, have been prevalent in markets before. It's just that this is a new manifestation of it. We saw this in merger mania in the 1960s when high stock prices meant that you could use your stock to acquire companies more easily because your stock is higher priced. So, and I'm wealthy as a company, so why not use that to acquire another company? If the market's rewarding me for that, I'm going to do it. And so higher stock prices beget more ability to acquire other companies, which means your stock price is rewarded by the market, which means you can do the same thing over again. These self-fulfilling feedback loops, these reflexive processes, as George Soros would say, cause markets in a variety of different cycles to swing way beyond what you would expect based on sort of the long-term underlying fundamentals in the economy and in whatever company you're looking at. And it's very at odds with the idea of an efficient market or equilibrium in finance. It's what creates booms and busts, and this time is no different, unfortunately. We're just seeing it through the lens of volatility in this discussion. and how quantitative funds and central banks are having their impact there. In terms of how this is resolved, it's hard to say the exact timing or catalyst, but what we do know is that markets can only stretch so far away from fundamentals before new positive catalysts fail to drive them any higher. And that's usually the first sign that a market is long in the tooth, i.e. positive earnings reports or positive economic data reports fail to result in the market moving higher. We're not there yet. The global economy is still quite strong, and market momentum is quite strong, although we have seen some signs recently as interest rates have perked up, of volatility perking up as well. And so keep an eye on that. Keep an eye on volatility, because the more it is able to sustain some upward momentum, the more perceptions around volatility and risk will slowly change. And by the way, the more these same quantitative funds that are feeding progressively lower levels of volatility into their models in order to forecast their portfolio volatility, remember the feedback loop we talked about where lower volatility is forcing them to buy more? If that flips, higher volatility will force them to sell more because the assets in their portfolio will be causing more volatility. So that's just an example of how virtuous cycles can turn into vicious cycles when there is a catalyst or when there is a change in momentum that causes this whole process to flip. So keep your eye on that. In terms of what we're doing in KPF Global portfolios, we continue to eschew the most expensive markets. The simple reason being, the most expensive markets have the lowest margins of safety. They trade very far away from their intrinsic values, and they have further fall as a result. Whereas a less expensive market that's trading near its intrinsic value will not have so far to fall. So that's what makes us value investors. We're inherently looking for assets that are not overpriced. And in this environment, that means avoiding US stocks and avoiding US high quality bonds. Those are two of the most overpriced assets in the world, particularly momentum assets, momentum sectors such as technology and biotech. So we're avoiding those. We're avoiding US high quality bonds, even though historically high quality bonds act as a hedge against rising volatility and falling equity markets. In this case, we're not so sure that's going to be repeated, because central bank interest rate policy, i.e. holding rates low, has been such an integral part of getting this market cycle to move higher and getting volatility to fall. So we actually think, and we are observing that right now, as just mentioned, that rising interest rates will be consistent with rising volatility when this particular cycle unwinds. So we're avoiding US long-term bonds. Instead, we're emphasizing international markets, which trade at more attractive valuations and have higher expected returns, international equity markets, and we're emphasizing cash and cash equivalents as a hedge rather than long-term bonds. Additionally, we're investing in the US covered call strategy, which writes calls against high-quality, large-cap US stocks. The high quality of the stocks means that they won't be as sensitive to recessions and any debt crises. And the call writing component means that we're selling away some of the upside in the stocks in exchange for enhanced income and a more stable return profile than would be the case with a traditional stock. All of those are ways that we're staying invested in the market, but we're increasing the defensiveness of the portfolio, and we're avoiding some of the most overpriced assets, and therefore reducing the potential drawdown in the portfolio. So that's all I have for today. I hope this was a stimulating discussion for you and that you learned something. If you have any questions about any of this, please don't hesitate to reach out to us at KPF Global. And with that, we'll see you next time.